When you hear the term asset pricing models, it is highly likely, if you're like me, when I first heard this term, that it does not really say anything. But it turns out that asset pricing models form one of the important pillars of finance. Let me motivate the importance of asset pricing models using an application. Joe is an analyst working for ExxonMobil. His job is to value oil reserves. In order to do so, he forecasts the future cash flows for a range of crude oil prices. And once he has these cash flows, he then discounts these cash flows back to the present to get the valuation of the oil reserves. So, this is a very standard application in finance. So, the question is what should be the discount rate that Joe should use? Well, the logical response is that it's going to depend upon the risk of the project. Okay. Then this leads to the question, how do you measure risk? And how does risk relate to return? So if you move from 1 unit of risk to 2 units of risk, how should the return change? Should it increase by 3%? Should it increase by 5%? What is the logic behind coming up with these numbers? What is the framework? Asset pricing models provide the answer. And for this reason, people who have worked in this area, including William Sharpe, who came up with the capital asset pricing model, and subsequently Eugene Fama at the University of Chicago, have been awarded the Nobel Prize in Economics. Asset pricing models build on the framework of optimal allocation that we have considered in the previous class. So, in this world, investors hold well diversified portfolios which lie on the efficient frontier. And if all of us hold these well diversified portfolios, then this leads to the question, what kind of risk do investors who hold well diversified portfolios care about? And more importantly, what are the types of risk that they do not care about? We can then ignore the type of risks that they do not care about, focus on the risks that they care about, measure this risk for each project, and then come up with a discount rate. So let's talk about risk. Risk refers to the possibility that the actual outcome deviates from your expected outcome. So your expectations are based on all the information that you have, but despite your best effort, what happens may be different from your expectation. For example, if you follow Mavericks basketball and you expect Dirk Nowitzki to score 25 points in the game tonight, when the game is complete, you find that he has scored only 15 points. So the difference between 15 and 25 points is your surprise. And this surprise could be because of reasons which are very specific to Dirk Nowitzki. For example, he sprained his ankle and you did not know about it, so you did not have the ability to incorporate it in your expectation. Or it could be for something market-wide, or in this case, American Airlines arena-wide. Maybe there was a lot of noise and players were distracted, and so everybody scored less than expected. So in the case of a stock, similarly, consider an oil company. You could have firm-specific surprise along the lines of BP discovering oil reserves along the coast of Venezuela. Or it could be a macroeconomic surprise along the lines of the Federal Reserve moving interest rates in an unexpected manner today, which then affects the price of your stock. Surprises, by definition, cannot be predicted. However, the impact of surprise on your portfolio can be reduced if you have many securities in your portfolio. This is because a firm-specific surprise gets offset in a portfolio. So some firm may have bad news, which results in a negative return, but on the same day, some other firm in your portfolio may have good news, which completely offsets the bad news. So these firm-specific surprises are idiosyncratic. It's peculiar to a company and can be eliminated in a well-diversified portfolio. So the only kind of risk that you care about in a well-diversified portfolio is this macro risk, which is being measured by the beta of the security. So in an asset pricing model, the only risk that you care about is the beta risk, or the sensitivity to macroeconomic shocks. So I'm being a bit repetitive, but the total risk is measured by the stock standard deviation. It's made up of two components: a risk that can be eliminated. This is the firm specific risk that we talked about. For example, accounting scandals or fire or deferred spending. These are all very specific to a company. This can be easily removed. If it can be easily removed, financial markets will not reward you for bearing this risk. Therefore, it does not show up in an asset pricing framework. The remaining risk is a systematic risk. This is the extent to which a stock or a company is sensitive to macroeconomic news, such as GDP, inflation, interest rates, oil prices, etc. And a macroeconomic shock or news impacts all securities, but the extent to which it impacts a particular security is going to differ. And this sensitivity is being measured by the beta risk, and this is what shows up in a asset pricing model. So you might ask, how much of the total risk is due to firm specific news and how much of the total risk is due to macroeconomic news? And a lot of research has been done to answer this question over the last 40-50 years. And here I have some good news to share with you. If you have only one stock in your portfolio, then you are exposed to both the firm specific and the macroeconomic risk. This is because there is no way for you to eliminate the firm specific risk. On average, the annual standard deviation of stocks is around 50%. So this is a huge number, a huge number. But as you start adding more stocks in your portfolio, as you move from 1 to 10, you can see that the risk of the portfolio declines. It drops by over 50%. And the reason you see this big drop is because the firm specific risk is being eliminated from the portfolio. So if you keep going down, you had 50 stocks, 100 stocks, 300 stocks, 500 stocks, 1,000 stocks, you can see that the risk of your portfolio keeps declining. Such that in a well-diversified portfolio of US stocks, only 40% of the total risk actually shows up in the portfolio. So this is the magic of diversification, which is that by doing something very simple, which is holding many stocks in a portfolio, you can eliminate over 60% or more of the risk of holding a single stock. This figure is a graphical representation of the previous slide. If you have just one stock in your portfolio, you are exposed to the total risk, which is a standard deviation. As you increase the number of stocks in your portfolio, the risk declines, such that when you move to 10 stocks, the risk drops by more than half. And as you start moving closer to 30 stocks, the risk drops even further, such that over 60% of the risk can be eliminated. Moving on to the APM, let me introduce the assumptions of the capital asset pricing model. The first assumption is that the marketplace is very competitive and efficient. So what that means is that there are a large number of buyers and sellers out there who are competing to purchase this security, and they are well informed, and they are rational mean variance optimizers, which means that they like more return to less return, and they demand a premium if they have to take on any risk, that is, they are risk averse. So these assumptions are easy to defend because they are quite logical. Markets are competitive. Traders use information that's available to them, and they don't like risk. We have a few more specialized assumptions here, which I will get into during our class discussions. But we will move on for now. These assumptions imply that our investors, in a world where they have only risky assets to choose from, will choose to be on the efficient frontier based on our discussions in the previous topic on portfolio theory. And once we introduce the risk-free asset, our investors would like to be on the tangency line from the risk-free asset to the efficient frontier. And therefore, all investors would identify this tangency portfolio M and would lie on this tangency line. This leads to the first equilibrium prediction, which is that our CAPM investors will hold a combination of the market portfolio and the risk-free asset on the tangency line. And because the market portfolio is well diversified, these investors, the CAPM investors, do not worry about unsystematic risk. So unsystematic risk is not priced. The only thing that our CAPM investors care about is market-related risk. The second prediction is that the expected return of a security is related to its systematic risk, which is measured by the beta, which equals the covariance of the return of the stock and the market divided by the variance of the market. Now, where is this particular covariance and variance term coming from? This is coming from just our basic statistics, where if you run a regression of y on x, y equals c plus b times x, the regression coefficient b here is equal to the covariance of y and x divided by the variance of x. So if you run a regression along similar lines of the return of the security on the return on the market, so Ri takes the form of y, Rm takes the form of x, then this leads us to beta b being equal to the covariance of the return on the stock and the return of the market divided by the variance of the market. So a stock with average level of risk has a beta of 1, which means that it rises and falls at the same percentage as the broad market index. And a stock with a beta greater than 1 is more risky than the average stock. A stock with a beta less than 1 is less risky than the average stock in the market. The last part of the CAPM is this very well-known relation between risk and return. So if beta is the measure of risk, then the expected return of the stock is equal to the risk-free rate plus the beta, which is the amount of risk, multiplied by the price of risk, which is the risk premium. Now, to motivate this particular relationship, we will be relying on the beta management case. There is a very nice mathematical derivation of this particular relationship, and I have posted the derivation on Canvas. For those of you who are interested, you're welcome to take a look at that. And if you have any questions, I'll be happy to provide clarification. This is a graphical representation of the equation from the previous page of the CAPM. So the expected return is on the y-axis. It's equal to the risk-free rate, which is the intercept here, plus the beta, which is the x-axis, multiplied by the price of risk, which is the slope of the line here. And this is the security market line. Now let's consider the intuition behind the beta measure. The beta of the average stock in the market is 1. So that is represented by stock 2 on the slide. So if the overall market return is a positive 1% today, the stock with a beta of 1 moves in the same direction for the same magnitude of 1%. On the other hand, if the overall market return is minus 1% today, then the return of this stock today is going to be minus 1%. So this is the average risk, so we consider it to be moderate. And if this risk is moderate, then you expect a moderate rate of return. Now, consider a stock which has a beta of 2, which is represented by stock 1 here. If the overall market return is 1% today, a stock with a beta of 2 goes up by 2%. But if the overall market return is -1 today, then the stock goes down by -2%. So as you can see, the stock is more sensitive than stock 2 to the overall market return. It goes up more when the market return is positive, and it goes down more when the market return is negative. To the average investor who's holding a well diversified portfolio, this stock is more risky, because when the portfolio is down by 1%, this stock actually hurts the portfolio by going down by more than 1%. So the investor does not like this stock. Because the investor does not like the stock, they are willing to only pay a low price for this stock today. And a low price for a stock implies that the return is going to be higher. So that's the relationship between how beta, which measures high risk, translates into a higher return. A stock with a high beta is less desirable. You pay less for it. If you pay less for it today, it means that your future returns are higher, and therefore high risk stocks have higher return. Now let's consider the flip side of it, which is a stock which has a negative beta, a beta of -0.5. So when the stock market goes up by 1% today, this stock has a negative return of 0.5%. But on the other hand, when the market is down by 1%, this stock has a positive return. So this stock is like an insurance policy. It stabilizes the portfolio because it chips in with returns when the portfolio overall is doing poorly. So I really like this stock. You really like this stock. All of us like this stock because we're all holding well diversified portfolios. Because we like this insurance type property of the stock, we are willing to pay a higher price for it. When we pay a higher price for it today, our future returns are lower. So the reason why a low beta stock has a lower return is because we all really love it. And because we all love it, we pay more for it. And because we pay more for it, we get a lower return. But that's okay, because we really like this attribute of the stock. So I'm sure you will all agree that the intuition underlying the CAPM is really beautiful. And for providing us with a way to think about which risk is important and which risk is not important, and how risk relates to return, William Sharpe won the Nobel Prize in Economics for suggesting this model. If you read the original Journal of Finance article, it has plenty of math, but really, William Sharpe did not win the Nobel Prize because he could do math. He won the Nobel Prize because he really provided this very beautiful economic intuition about how to think about risk and how to measure risk and how risk relates to return. And for his contributions, he won the Nobel Prize. So we'll talk more about this in class.